Ever pondered about what alpha or beta in finance signifies? Let's unravel these intriguing concepts that are fundamental in the world of finance. Alpha, a term as intriguing as it sounds, is all about surpassing expectations. It signifies the excess return of an investment compared to the return of a benchmark index. Imagine you're an investor, and your investment outperforms the market index. That extra return is your alpha. It's the trophy you get for your strategic prowess and smart decision-making. Now let's talk about beta. If alpha is the star player, beta is the coach understanding the game. Beta represents the systematic risk of a security or a portfolio compared to the market as a whole. It's the measure of your investment's volatility, the roller coaster ride in the market. Beta helps you understand how much risk you're taking compared to the broader market. So, in essence, alpha is about outperformance, while beta is about risk. Now how about the bid-ask spread and the capital market line? Let's dive right in. The bid-ask spread is a financial term that describes the gap between the highest price a buyer is willing to pay for an asset and the lowest price a seller is ready to accept. It's like a haggle dance between buyers and sellers, each trying to get the best deal. This spread is critical because it reflects the liquidity of the market. A smaller spread indicates a more liquid market, while a larger spread suggests less liquidity. Switching gears, let's touch on the capital market line, or CML. This line, a key component of the capital market theory, illustrates the trade-off between risk and return for efficient portfolios. It essentially shows that the higher the risk, the higher the potential return. It's like a seesaw, balancing risk on one side and return on the other. Thus, the bid-ask spread shows market liquidity, while the CML indicates optimal risk-return trade-offs. Ever wondered what a commodity is or what day trading involves? Well, let's dive right in. A commodity in the simplest terms is a basic good used in commerce that is interchangeable with other goods of the same type. These are often natural resources like oil, gold, and wheat. What makes commodities intriguing is their universal nature. No matter where you are in the world, a barrel of oil or an ounce of gold holds the same intrinsic value. Now, let's shift gears to day trading. This is the high-speed world of finance, where securities are bought and sold within a single trading day. It's like a game of chess, with players making strategic moves to capitalize on small price fluctuations in highly liquid stocks or currencies. But remember, while the potential for quick profits is high, so is the risk. In a nutshell, commodities are interchangeable goods, and day trading is all about quick transactions. How about the discount rate, dividend reinvestment plan, and the efficient market hypothesis? Let's start with the discount rate, a crucial concept in the world of finance. It's the interest rate used in discounted cash flow analysis to determine the present value of future cash flows. Basically, it helps us understand how much future money is worth today. Next up is the dividend reinvestment plan, often abbreviated as DRIP. This is a plan offered by a corporation that allows investors to reinvest their cash dividends by purchasing additional shares. Instead of receiving dividends in cash, you get more shares, which can lead to exponential growth over time. Lastly, we have the efficient market hypothesis, or EMH. This hypothesis posits that share prices reflect all available information. Therefore, consistent alpha generation, that is, consistently outperforming the market, is considered impossible according to this theory. So, the discount rate determines present value, a DRIP lets you buy more shares, and the EMH posits that all information is already in the price. Lastly, let's talk about the ex-dividend date, fiscal policy, and forward contract. The ex-dividend date is something of a deadline. It's the very last day you can buy a stock and still be entitled to its next dividend payment. Think of it as a cutoff, a point of no return. If you buy the stock after this date, you won't get the dividend. It's the stock's way of saying, sorry, you're too late for this payout. Moving on to fiscal policy, this is essentially how a government tries to steer its economy. By adjusting its spending and tax levels, a government can either stimulate economic growth or rein it in. It's like the captain of a ship, adjusting the sails to catch the wind just right. Finally, a forward contract is a deal made today for a transaction that will happen in the future. It's a pact between two parties to buy or sell an asset at a predetermined price on a specific future date. So, the ex-dividend date is about dividend eligibility, fiscal policy controls an economy, and a forward contract is a future deal at a fixed price. Thanks for watching. Leave a comment or like if you enjoyed this video. See you next time.